Alright guys, welcome back to the channel. Today I'm going to explain the Wyckoff method, simplified, no bullshit, and straight to the point. Now, before we get started, I quickly want to talk about this service that I created at the end of December, and it's now live since the 1st of January. It's a community of like-minded traders. Back in the day when I was learning to trade, I was alone. And it would really have helped me if I had a place where I could ask questions to someone that was already at the level I wanted to be. That's why I created this community. It comes with weekly workshop videos. So if you are part of the community, every week you get a video that will make you a better trader. Next to that, you can see my trades, how I execute, what I look for, etc., etc. You get one-on-one support with me. So let's say you have a question, you can simply ask your question. I will give you answers. And that way you can quickly progress as a trader. And of course, you have a community chat. If you want to know more about this, click the link. It's below this video. And if you have questions, you can always contact me. Now, let's go on with the video. I'm going to talk about the following topics. What is the Wyckoff method? What it's not, that's really important. Key things to keep in mind. Market cycles, diving deeper, the most important points, and taking action. So what is the Wyckoff method? It's a trading method developed by Richard Wyckoff when he was working as a broker. So Richard worked as a broker, and because he worked as a broker, he could see orders going in, going out, and by observing these things happening again and again, studying supply and demand, he eventually developed this trading method. So it's supply and demand analysis to determine the dominant side of the market. That's essentially what you're doing with the Wyckoff method. You identify so-called smart money to see what they are doing. Now, to quickly clarify that, smart money or bigger players in the market, they can't just buy like we do. So when they have a huge order that they need to get in the markets, they tend to split up that order in smaller pieces because let's say they want to buy, and this is just an example, let's say they want to buy 1 million shares at a price. That means on the other side, there needs to be 1 million shares selling to that particular person, to that fund or whatever it is. Now, if that's not the case, one part of the order will be filled at that price, but the rest will be filled at a higher price. If you have a lot of money that you need to put in the markets, this difference in prices can immediately add up, and it basically cuts your profits and puts you into a loss. Because essentially, if you want to buy at a certain price, but you have to buy it at a higher price, that difference is essentially a loss in profits. And to combat that problem, bigger players trade at areas of high liquidity, and they tend to put their orders into smaller portions, basically, and then put that in the market. So they scale and they build a position. So that's what you need to know about this. Now, what is the Wyckoff method not? So it's not the Holy Grail. Lately, the Wyckoff method has become very popular and people say it's the Holy Grail and you should know smart money trading or whatever the case may be, but it's not. You can make money with support and resistance. You can make money with this concept. You can make money with, I don't care what concept it is. And I will explain later why that's the case. So it's also not a tool to consistently make 1 to 100R trades, which you also see on the internet a lot. Yes, the Wyckoff method can give you a nice risk to reward trade because you tend to get in at the origin or close to the origin of a move, but making these types of trades is ridiculous. I don't know any professional trader that makes trades like this on a consistent basis because it's not possible. Next to that, it's hard emotionally because you have a very low win rate, etc., etc., etc. So it is not the Holy Grail and you cannot make this consistently. Key things to keep in mind before I go to the charts. I'm going to show you examples later on, but there are just a few things you need to keep in mind. Simple is better. The Wyckoff method is quite subjective and it can be quite complex. Especially if you Google the Wyckoff method, you will find all sorts of information and people tend to get confused by this. So always keep in mind, simple is better. You can always make things more complicated later on. You can make it as complex as you want to, but if a strategy is simple, It's easier for you to trade in the live markets because you know what you're looking for instead of being all over the place. It's also easier to keep track of your performance, and it's easier to backtest and get some statistics about the strategy. But if you're, let's say you have a complex strategy, you need to know the fundamentals. You need to know the weekly time frame, the daily time frame, the hourly time frame, this and this and this. Then it becomes so hard to even backtest and to trade your strategy without making mistakes, which is really important in trading. So if you watch this video and after this you get started with the information provided, please keep it really simple. It doesn't have to be complex. My strategy is so simple, and that's the power of it. It's simple. I can execute it without mistakes. That's why I make money. Now, this point is really important. Every method that you learn is simply a lens that you use to view price. Find a lens that fits you and develop an edge around this. And that brings me back to the beginning of what I said. You can make money with all sorts of different strategies. It's up to you to find that one thing, that strategy that fits with you as a person. And everyone is a bit different. So that's what you need to think about. And when you found that concept or that method that actually makes sense to you, then you build your edge around it. So then you start developing rules, testing things, and that's the progress of really building an edge and becoming profitable. But it's essential that the method or the lens that you use to view price fits with you as a person. So keep that in mind. Let's dive into some actual charts and graphs. Now, this is basically how markets work. Markets go from ranging to trending to ranging to trending, or if you use the other terms, you have balance, then you have imbalance or aggressive moves, then you have balance again, and then you have imbalance in this leg up, then you create balance, then you got imbalance, etc., etc., etc. That's how markets work. And essentially you can label those as an accumulation range, which is a range before an uptrend, a reaccumulation range, which is a range during an uptrend, and then your distribution range, which is the range that starts a downtrend, and a redistribution range, which is a range within a downtrend. Those are basically the four main ranges you have. You have some other ones, but these are the main things, and that's how markets work. It's important to realize that trends, real trends, hardly change without any form of ranging or building positions. We do know the V-shaped return. Yes, they do happen, but more often you get these type of patterns before you get a reversal. So that's really important. If we take a deeper look at what this is, then during an accumulation range, you essentially have a double bottom. And during accumulation ranges, bigger players tend to build positions inside this range. Why? Because there's balance in price, because buyers and sellers are up and down, transacting here, transacting there. So there tends to be quite some volume when there is a range and when prices are stable. And when you have volume at around the same pricing, it's easier for a bigger player to build in a position at around the same pricing. So that's when you have your accumulation. Then below the low of the range, you often get stop orders, basically from two types of players in the market. Number one, people think as soon as this breaks, there will be a continuation to the downside. So what they will be doing? They will be selling, and they will be selling at the breakout or either at the retest, but they will be selling using market orders or sell stops or even sell limits at the retest. The point is they will be actively selling through the lows. And this is not just retail traders, also bigger players. They sometimes put in huge orders to sell at those types of areas. Now, what you also have is people that bought in this range that were smart enough to be like, okay, I think price is going up. They put this stop below the lows. So the stop loss from someone that buys is a sell order. If you buy at this level and your stop loss is below here, the loss that you have is because you bought and then you sell your position back at the lower price. And this distance right here, that's your loss. So you have two type of parties selling at that area. And because there's a lot of selling, it's an excellent area for a bigger player to go long. So when you see an equal bottom in a range like this or a triple bottom, whatever it is, price goes down and very quickly shoots up back into the range really aggressively. Very often there's a bigger player that absorbed the selling in here, whether it did passively or just aggressively. Doesn't matter, you can see absorption happening there. If you trade a market with level 2 data, you can take a look at the footprint and you can see this happening. Not always, but often you can see some type of trap, so actively selling and then price going up, and you can see that there's absorption there. So that's the start of an uptrend. Then you often get a retest of the range. So here we break out. Often you get a retest. The reason being is profit taking more often than not. That's basically what you want to see. You don't want active selling happening and aggressive selling happening there. But if there's just profit taking there and you get a slow kind of rounded retest or flagging move, that's often what you want. And then you can see that often these areas get retested because there are orders resting, and that's why you get the bounce. And then you get your reaccumulation ranges until there's a reason for a bigger player to step in and either take profits or start with shorting a particular market. And that's when you get your distribution range. Basically the same thing happening, but in the opposite direction. So if we take a look at an actual chart, so let me clean this up first. Let's take a look at an actual chart. This is a distribution range. Aggressive move up, and that's really important. Reversals tend to happen with aggressive moves. And that's just really, really key. When there's an aggressive move up, you will get a lot of people anticipating in continuation, and often that is when reversals happen. So we can see an aggressive move up, we form a high here, and then during this ranging period, we form a lot of unbroken highs. What does that mean? That there's liquidity, often, not always the case, but often liquidity is being built above all these highs. Then we break all these highs, and as soon as we break all these highs, you can see price aggressively going down. This tells you that someone absorbed the available liquidity there. You can see this is the low of the range. You can see we form some base, and then we aggressively break out of the low. What tends to happen is that we come back to retest that area and then continue down, as you can see here. So this is essentially how this works, and this is a distribution range. Now, what are the most important parts to look for? Because if you Google the Wyckoff method, you can see phase analysis, volume spread analysis, phase A, phase B, LPS, spring, selling climax, all these things. In my opinion, the most important parts to look for are the range, absorption, false breakouts, acceptance. Now, what do I mean by that? If you're going to trade this method, the most important things are you want to see some type of range with some equal lows, equal highs forming. Then you want to see what happens if one side of the range breaks. So let's say the downside breaks. You want to see what happens. If we accept here, then that's not what we're going to be looking for. However, if we immediately go up aggressively, that's what you can call absorption and a false breakout. Then you want to see on the other side acceptance. So basically on the other side, because there are often equal highs, you can always expect liquidity to be resting here as well. What we don't want to see is the same price action that we had here over here. So here we want to see aggressive absorption, aggressive move back into the range. Here we want to see acceptance of the range, price slowly grinding down maybe, or even continuing up a bit, then grinding down, and then until the retest area. This is what you want to see here. So basically acceptance of price instead of absorption and quick moves. And those are the most important parts. And if you only take a look at those 4 things using the Wyckoff method, so nothing else, you can see that it becomes relatively easy to apply this method. And because of that, it's easier to build an edge around this. So what can you do with all this information? Take action, of course. If you don't take action, this video won't make any difference. If you read about working out, but you never work out, you will still be fat. That's how it works. Taking action makes the difference. So what can we do? Develop rigid rules to determine which trades you should and shouldn't be in. And that brings me back to the previous slide. Those are the 4 things that you want to be looking for. But then you need to be very, very specific. How will you identify the correct ranges? How will you identify the false breakout? How will you identify acceptance? You need clear rules for this, because when you have clear rules, you can backtest the rules. You want to see with any trading method that you use, you want to see, has it worked in the past? If it hasn't worked in the past, why would it start working in the future or in the present? Doesn't make any sense. If you develop a trading method that worked for the past 10 years, thousands and thousands of trades, then you have confidence, okay, this might probably work in the future. So build rigid rules, backtest to see the past performance, improve where you can. So what if I place my stop loss in this area instead of this area? What if I manage my trades? What if I don't manage my trades? You start doing these things to improve the strategy. Once you have something that's not curve fitted, that fits with you, that you understand, that you tested, and that's profitable, you try to trade this on a demo account. Now, don't get me wrong, demo, like, you can learn something on it. Most people are like, never trade demo, it's not real money, this and that. But what I say to those people is, if you're not profitable on demo, you will not be profitable with live money. So why on earth would you deposit a lot of money to find out that you can't trade? First, you should be profitable with backtesting, then you should be profitable with demo. And if you're profitable on demo for some time and you executed your strategy without mistakes, then you deposit the money and then you go live. So that's it for today. Hopefully you learned a lot. If you have questions, let me know. Again, about the trading community, link below the video for more information. Subscribe so you don't miss anything, and I'll see you next time.